October 1929. Wall Street crashes. 89% of wealth vanishes overnight. It took 25 years just to get back to zero. 2008. The housing market implodes. Stocks crater 57%. Millions lose their homes. 5 brutal years to recover. But what's coming in 2025 is something we've never seen before. Not just stocks crashing, not just real estate collapsing, everything. Simultaneously, stocks, bonds, real estate, all 3 pillars of wealth, crumbling at the same time. This is the everything bubble. And if you think I'm being dramatic, let me show you the math. Here's the terrifying truth. We're living in 1928 right now, standing on the edge of the cliff. But this time, when we fall, there's no safety net. The Federal Reserve already fired all its ammunition, fighting the last crisis. Interest rates? Already used. Money printing? Already caused the worst inflation in 40 years. The rescue tools are empty. In the next 12 minutes, I'm going to walk you through 3 massive bubbles that are about to explode. I'll show you 12 red flags that Wall Street insiders are already reacting to. And I'll give you the exact danger window, November 2025 through June 2026. This isn't speculation. This is pattern recognition. This is mathematics. And by the end of this video, you'll understand exactly what's coming and why most people are completely unprepared. Let's dive in. Part 1. The 3 bubbles nobody's talking about. Bubble 1. The stock market time bomb. Right now, the stock market is more overvalued than it was before the Great Depression. I'm not exaggerating. Let me show you the numbers. The S&P 500 currently trades at a price-to-earnings ratio of 28. The historical average, 15 to 17. We're almost double the normal level. The last time we saw valuations this extreme was right before the 1929 crash and the 2000 dot-com implosion. Both times, the market lost over 50% of its value. But here's what makes today even more dangerous. Extreme concentration. 7 tech stocks, the Magnificent 7, now make up 30% of the entire S&P 500. Apple, Microsoft, Alphabet, Amazon, Nvidia, Meta, Tesla. 30%. Think about that. If just 2 or 3 of these companies stumble, they'll drag the entire market down like an anchor. And they will stumble. Let me show you why with one perfect example. Nvidia is currently trading at a price-to-earnings ratio above 65. 65 times earnings. Why? Because everyone believes artificial intelligence is going to change everything overnight. Does this sound familiar? In 1999, everyone believed the internet was going to change everything overnight. Pets.com was going to revolutionize pet food. We all know how that ended. I'm not saying AI isn't real. It is. But valuations have gotten completely detached from reality. And when reality hits, it hits hard and fast. The concentration risk is the setup. The AI hype is the fuse. And the match is already lit. Bubble 2. The real estate nightmare. If you think housing is expensive, you're right. But it's worse than you think. Residential real estate prices are currently 50% above the long-term historical trend. 50%. That's actually higher than the peak of the 2008 housing bubble, which was only 43% above trend. Let that sink in. We're in a bigger housing bubble right now than the one that nearly destroyed the global financial system. But residential real estate isn't even the main event. The real catastrophe is commercial real estate, and nobody's talking about it. Office vacancy rates in major cities have hit 45%. San Francisco is at 35% empty. New York, Chicago, Austin, same story. Office buildings that were worth hundreds of millions are now worth half that, or less. But the loans on those buildings are still at full value. And here's where it gets truly terrifying. The maturity wall? Hundreds of billions of dollars in commercial real estate loans were taken out between 2020 and 2021 at interest rates of 2 to 3%. Those loans are coming due right now. They need to be refinanced. But current rates are 7 to 9%. Do the math. A building that barely breaks even at 3% interest goes deeply underwater at 8% interest. The owner can't refinance. They can't sell because nobody will pay the old valuation. There's only one option. Default. We're looking at a wave of commercial real estate defaults that will make 2008 look like a practice run. And those defaults will flow directly into the banking system. Which brings us to the third bubble. Bubble 3, the government debt trap. This is the bubble that nobody sees coming, and it's the most dangerous of all 3. For decades, government bonds were considered the safest investment on earth. When stocks crash, you buy bonds. When real estate collapses, you buy bonds. Bonds are the safe haven. The last line of defense? Not anymore. The United States government now owes $36 trillion. That's 125% of our entire gross domestic product. We haven't seen debt levels this high since World War II. But here's the difference. After World War II, we were the only industrial economy left standing. We had decades of growth ahead of us. Today, we're competing with the entire world, and our growth rate is slowing. But the debt number isn't even the scariest part. The scariest part is the interest on that debt. We're now paying $1.2 trillion per year just in interest payments. That's more than we spend on defense, more than we spend on Medicare, more than we spend on education. We're paying $1.2 trillion per year just for the privilege of staying in debt. And interest rates are still relatively low historically. If rates go up another 2%, we'll be paying $2 trillion per year in interest alone. That's almost half of all tax revenue going just to interest payments. The government has three options: cut spending dramatically, raise taxes massively, or print more money. Cut spending, politically impossible. Raise taxes, it would crash the economy. Print money, that's what caused our recent inflation nightmare. There is no good option. The trap is already set. So when the stock market crashes and real estate collapses, where does money usually go? Bonds. Safe, stable government bonds. But this time, bonds are part of the problem. This time, there is no safe haven inside the system. That's what makes this the everything bubble. When all three pillars collapse simultaneously, there's nowhere to hide using traditional investments. Part 2. Why this time is different and worse? I know what you're thinking. We've heard this before. People have been predicting crashes for years. The market keeps going up. You're right. Perma-bears have been wrong again and again. But let me show you why this time the pattern is different. The parallels to 1929 are almost perfect. Extreme valuations? Check. Record margin debt where people borrow money to buy stocks? Check. Wealth inequality at all-time highs? Check. Speculative mania in new technology? Check. But here's why 2025 is actually worse than 1929 and why the impact will be more devastating. In 1929, only 10% of Americans owned stocks. When the market crashed, it destroyed the wealthy elite, but most regular people didn't have direct exposure. They suffered through the Depression because of job losses and bank failures, but their personal stock portfolios didn't evaporate because they didn't have any. Today, 58% of American households own stocks, primarily through retirement accounts, their 401k, their individual retirement account, their pension funds. When this market crashes, it will instantly vaporize the retirement savings of more than half the country. There's no buffer, no separation. The wealth destruction will be immediate and personal for tens of millions of families. The banking system is also far more fragile than people realize. The FDIC, the Federal Deposit Insurance Corporation that protects your bank deposits, has only $125 billion in its insurance fund. Sounds like a lot, right? But there are $10 trillion in insured deposits in American banks. That's a ratio of 80 to 1. If we get a cascade of bank failures, that insurance fund disappears in days, maybe hours. And here's the real nightmare: the Fed trap. In 2008, the Federal Reserve had powerful weapons to fight the crisis. They cut interest rates by 5.25% all the way down to zero. They implemented quantitative easing, creating trillions of dollars to buy bonds and mortgages. It was controversial, but it worked. It stabilized the system. Today, the Fed is trapped in a box with no exit. If they cut rates aggressively to fight a recession, they'll reignite inflation. We just lived through that nightmare. Inflation hit 9%. Groceries became unaffordable. Gas prices exploded. People are still hurting from it. The Fed can't go back there. But if they don't cut rates aggressively, the recession will be deep and brutal. Unemployment will spike. Businesses will fail. The economy will crater. They're trapped between two catastrophic outcomes. Cut rates, get inflation. Don't cut rates, get depression. There is no good choice. The ammunition is gone. The credibility is damaged. The tools have been exhausted. Part 3. The 12 warning signals. Let me walk you through the indicators that are flashing red right now. These aren't opinions. These are data points that have predicted every major crisis for decades. Signal 1. The yield curve. The yield curve inversion is the single most reliable recession predictor in modern history. It has predicted every recession since 1950 without a single false positive. Every single one. The curve inverted in 2022 and normalized in September 2024. Based on historical patterns, recessions typically occur 3 to 12 months after normalization. That puts the danger zone between December 2025 and September 2026. The clock is ticking. Signal 2. Consumer exhaustion. American consumers are tapped out. Credit card debt just crossed $1.14 trillion. The average interest rate on those cards? 22 to 28%. Delinquency rates are at the highest level since 2011 and rising every month. This matters enormously because consumer spending represents 68% of the entire economy. When consumers can't spend anymore, the economic engine stalls. And right now, consumers are running on fumes. Savings rates have collapsed. Americans burned through the pandemic stimulus money. Student loan payments resumed, taking hundreds of dollars per month out of millions of budgets. Real wages, adjusted for inflation, are still below 2019 levels for most workers. The consumer, the engine of the economy, is breaking down. Signal 3, the smart money is screaming. This is where it gets really interesting. The people with billions of dollars and access to the best information in the world are taking dramatic action. Corporate insider selling is at record levels. Jeff Bezos sold over $8 billion in Amazon stock. Mark Zuckerberg sold billions in Meta. Jamie Dimon sold millions in JP Morgan Chase. These aren't small portfolio rebalances. These are massive liquidations. But the biggest signal comes from Warren Buffett. Berkshire Hathaway is now holding $325 billion in cash and short-term treasuries. That's the highest cash position in the company's entire history. Warren Buffett, the greatest investor of all time, the man who built his fortune by buying when others are fearful, can't find anything worth buying right now. The Buffett indicator, which he himself called the best single measure of market valuation, currently stands at 185%. That's the ratio of total market capitalization to GDP. Buffett has said anything above 120% is dangerous. We're at 185%. We're 65 percentage points into the danger zone. When the smartest money in the world is sitting on the sidelines holding cash, you should pay attention. Signals 4 through 12, the perfect storm. Let me rapid fire through the other red flags. Corporate debt is at all-time record highs while profit margins are starting to compress. Companies borrowed heavily at low rates. Now they're facing higher rates and slower revenue growth. That's a toxic combination. Auto loan delinquencies are spiking. People are defaulting on car payments at rates we haven't seen since the last recession. Mortgage purchase applications are at multi-decade lows. Nobody can afford to buy homes at current prices with current interest rates. Commercial real estate delinquencies are accelerating. Every month, more buildings go into default. Bank reserves are declining as deposits flee to higher-yielding money market funds. The Housing Affordability Index is at the worst level ever recorded. Worse than 2006, worse than 2007, worse than the peak of the last bubble. Small business optimism is falling, despite what the headlines say about a strong economy. And finally, geopolitical risks are at multi-decade highs. Wars in Ukraine and the Middle East, tensions with China, political dysfunction in Washington. Every crisis amplifies the others. Each of these signals alone would be concerning. All 12 flashing red simultaneously? That's a 5-alarm fire. Part 4. How the cascade unfolds. Let me walk you through exactly how this plays out. Not to scare you, but so you understand the mechanism. Because once you see the cascade, you'll understand why it's virtually unstoppable once it starts. Stage 1. The trigger event. It starts with disappointment from the Magnificent Seven tech stocks. Maybe it's one company. Maybe it's several. The quarterly earnings come out. Revenue growth is slowing. The AI revolution isn't generating profits as fast as everyone expected. Reality meets hype. Reality wins. The algorithmic trading systems that dominate modern markets immediately trigger sell programs. High-frequency traders race for the exits. Within hours, the big tech stocks are down 5 to 10%. Stage 2. The margin call cascade. Now the real fun begins. Thousands of investors bought stocks on margin, meaning they borrowed money from their brokers to buy more stocks than they could actually afford. When prices drop, those brokers issue margin calls. Either deposit more cash or we'll sell your stocks to cover the loan. Most investors don't have extra cash sitting around, so the broker automatically sells their stocks. This forced selling drives prices down further, which triggers more margin calls, which forces more selling. It's a death spiral that feeds on itself. Current margin debt is near all-time highs. When the cascade starts, we could see 30 to 40% declines in the first 30 days. Not 30 to 40% over a year. In 1 month. Stage 3. The wealth effect disappears. As stock portfolios crater, people suddenly feel poor. The couple that felt comfortable retiring because their 401k hit $2 million watches, it dropped to $1.2 million in weeks. They cancel their retirement plans. They stop spending on discretionary items. They put off buying a new car. They definitely don't buy a vacation home. The wealth effect in reverse is devastating. Consumer spending falls off a cliff. And remember, consumer spending is 68% of the economy. Stage 4. Real estate freezes, then collapses. With stocks crashing and consumers retreating, the real estate market freezes first. Nobody wants to buy when the world feels like it's ending. Sellers refuse to lower prices because they can't accept that their home is worth less than it was 3 months ago. The freeze lasts weeks, maybe a couple months. Then reality sets in. Sellers who need to sell start dropping prices. First 5%, then 10%, then 20%. In high-priced markets like San Francisco, Austin, Miami, prices could fall 40 to 50% from peak to trough. Commercial real estate is already collapsing. As more tenants default and more buildings go into foreclosure, the values plummet even faster. Stage 5, the banking crisis. Banks are loaded with commercial real estate loans that are going bad. They're holding government bonds that are losing value as interest rates spike. Their consumer loan portfolios, mortgages, credit cards, auto loans are all seeing rising defaults. The smaller regional banks fail first. Then some mid-sized banks. The FDIC steps in, but remember, they only have $125 billion to work with. That money evaporates quickly. The government has to step in with emergency funding, which means creating new money, which threatens to reignite inflation. Stage 6, the unemployment surge. Companies facing falling stock prices, collapsing consumer demand, and tightening credit do what companies always do in a crisis. They cut costs, and the biggest cost is labor. Layoffs start in tech, where valuations are most inflated. Then they spread to finance, to retail, to manufacturing, to services. Unemployment, currently around 4%, could surge to 12 to 15% within 12 months. We haven't seen numbers like that since the Great Depression. But the mathematical cascade makes it virtually inevitable. Stage 7, the personal devastation. Your retirement account, that 401k or IRA you've been building for 20 or 30 years, could lose 60 to 70% of its value in 12 to 18 months. If you were planning to retire in the next 5 years, those plans are destroyed. You're working another decade at minimum. If you're young, you're looking at a 10 to 20 year recovery period just to get back to the peak. Japan experienced this after their bubble burst in 1990. 35 years later, their stock market only recently got back to those 1990 levels. An entire generation of wealth creation erased. Stage 8, the social unraveling. This is where it gets truly dark. A generation of young people enters a job market with no entry-level positions, college graduates with student loan debt and no job prospects. Retirees forced back to work because their savings evaporated. Middle-aged workers laid off and unable to find new work. The social contract fractures. Political extremism grows. Faith in institutions collapses. This isn't speculation. We've seen it happen in other countries. It happened here in the 1930s. The social and political consequences of economic catastrophe are often worse than the economic consequences themselves. Part 5. The math that guarantees the outcome. Let me synthesize all of this into one clear picture. We have 3 simultaneous bubbles. Stocks overvalued by historical standards. Real estate higher than the 2008 peak. Government debt at levels that are mathematically unsustainable. Each one alone would be concerning. All 3 together, unprecedented. We have exhausted rescue tools. The Fed can't cut rates to 0 without reigniting inflation. They can't print unlimited money for the same reason. The government is already drowning in debt. There is no cavalry coming over the hill to save the day. We have 12 major warning indicators all flashing red at the same time. The yield curve, consumer exhaustion, smart money exits, corporate debt, banking stress. Every single pressure point is at or near crisis levels. And we have a cascade mechanism that's virtually unstoppable once it starts. Margin calls feed on themselves. The wealth effect works in reverse. Unemployment begets more unemployment. It's a doom loop with no natural breaking point. The expected declines based on historical patterns and current valuations. Stocks could fall 65 to 80% from peak to trough. Government bonds could drop 35 to 50% in a real crisis of confidence. Real estate could decline 40 to 60% in the most overvalued markets. The timeline? Based on the yield curve normalization and other leading indicators, the danger zone is November 2025 through June 2026. We're talking about 6 to 8 months from right now. Here's what I need you to understand. I'm not a perma-bear who predicts a crash every year. I'm not a gold bug trying to sell you something. I'm a financial analyst who studies patterns, and the pattern we're in right now has only happened a few times in modern history. And every single time, it ended in catastrophe. The question isn't if this cascade happens. The mathematical setup guarantees it will happen. The only questions are exactly when and how severe. And the final question, are you prepared? The bigger danger nobody sees. But here's what most people don't understand. As catastrophic as these 3 bubbles are, they're not even the biggest threat to the financial system. There's a fourth bubble, a hidden bomb that's ticking underneath everything we just discussed. It's something most people have never heard of, but it makes everything else look small by comparison. The derivatives market. $600 trillion in notional value. That's not a typo. 600 trillion. To put that in perspective, the entire global economy is around $100 trillion. This derivatives market is 6 times larger than the entire economy of planet Earth. Warren Buffett called derivatives financial weapons of mass destruction back in 2002. That was 15 years before the 2008 crisis, and he was proven right. Derivatives, specifically mortgage-backed securities and credit default swaps, nearly destroyed the global financial system in 2008. Today, the derivatives market is 10 times larger than it was then. 10 times. And it's all interconnected through a web of counterparty risk that nobody fully understands. Here's what counterparty risk means. Bank A owes Bank B owes Bank C owes Bank D, and Bank D owes Bank A. They're all connected in a circular chain. If any one link breaks, the entire chain explodes, and the explosion happens at the speed of light because it's all electronic trading. 4 banks, just 4, control 90% of the entire derivatives market. JP Morgan Chase, Bank of America, Citigroup, and Goldman Sachs. If any one of these banks faces a crisis, it could trigger a cascade through the entire derivatives market in hours. This is the real systemic risk. This is what keeps central bankers awake at night. This is the weapon of mass financial destruction that's bigger than all 3 bubbles combined. In my next video, I'm going to expose exactly how the derivatives market works, why it's so dangerous, and which specific banks are holding the most risk. More importantly, I'm going to walk you through the specific actions you need to take right now to protect yourself. Because while you can't prevent the everything bubble from bursting, you can prepare for it. There are assets that maintain value during crises. There are strategies that protect wealth when everything else is collapsing. And there are moves you can make right now, today, that will position you to not just survive the coming crash, but potentially even profit from it. Gold, treasury bills, cash positions, international diversification. These aren't sexy strategies, but they work when everything else fails. The everything bubble is going to pop. The cascade is going to begin. The mathematics guarantee it. Whether it starts in 3 months or 9 months, I can't tell you with precision, but I can tell you with certainty that it's coming. The only question that matters is, will you be ready when it does? Subscribe and hit the notification bell because the next video might be the most important one you watch this year. I'm going to show you exactly how to protect everything you've worked for. The storm is coming. Let's make sure you're not standing in the rain.